Everyone across the pond, this is Mish Schneider, Chief Strategist of MarketGauge.com, back from a very lovely break overseas, well rested, and thank you, market, for being so cooperative while I was gone in giving us a very nice rally. So of course today was the CPI numbers, and the market may have overreacted. We've got some resistance if you're looking at some of the longer term charts. But what we're going to do today is we're going to cover the gold, the oil, natural gas, which has been incredibly uninteresting, also the S&P, and I want to add one agricultural stock, or I should say future, to it, and that would be soybeans, because it could be an interesting contrast to what people think now about inflation. Of course, I am still not convinced this is exactly kind of what we anticipated, which would mean somewhat of a cooling with energy prices, somewhat of a cooling of the inflation numbers. Doesn't mean inflation's over, it's just the momentum of it rising has eased. Some kind of monetary policy slip, like the Fed being done raising rates, talking about cuts in 2024, a weaker dollar, still a short supply, still a lot of geopolitics, and whammo, a new super cycle in commodities. So we're going to start here with the gold market because we would see this reflected here. And what's so interesting about the gold, this is the daily chart of the gold market right now, is that we did come down since I've been gone, tested the 50-day moving average. So that 1938 level, super important right now, but we've not been able to get back over the 200 at 1980. So that's your wider range. For right now, I would say if we were looking at a momentum chart, you would say on the momentum chart right now that the momentum is certainly not cooperating with the price, and that's part of the reason. You want to see momentum coming in. Gold, when it rallies without momentum, has done what gold has done. Sells off when it looks great and also becomes a buy when it looks really bad. We need that cycle to break. What we're looking for is momentum and selling to dry up, the next trip at 2000, momentum to increase, and then of course it'll be off to the races. But for right now, that hasn't happened yet. So from a very short-term standpoint, we have a lot of congestion here somewhere around the 1970 level. Let's call it 1965 to 1970. That's going to be your initial support coming into tomorrow, with some more inflation numbers coming out. If we can gap up above 1965 to 1970, that would be bullish. Obviously, we have to get through this 1980, but if we do, I think we get to 2000, and I'm still looking at a potential 3000 in gold, maybe not necessarily by the end of this year, but into 2024. Where would I change my mind? That would be probably right now a break of 1930, but I really wouldn't be convinced until we broke down under, let's say, 1900. And by the way, this is the December contract. Now I'm going to show you a different look at the S&P. This is the S&P 500 index. Right into a lot of resistance where we were trading not that long ago, really, in September, if you think about it. So at this point now, we're testing some really good resistance at 4,500. But we get through 4,500, I don't see any reason why we can't get to 4,600, maybe even 4,650. But right now, what we want to see first and foremost is today's low at 4,455 to hold because of the gap. You don't want to see the gap get filled. So we're going to play off of that 4,455 number. We may actually get some digestion and an inside day tomorrow. That would not be surprising to me at all. And of course, if we can get through today's highs, you can see above that 4,500, things start to look interesting, with a teeny weeny gap to fill up here at 4,566. If we break down under today's low, under 4,455, then of course we would have to start looking at not only a gap fill, but the next area of support would be about 4,400, and then of course down at around the 50-day moving average at 4,337. But I want to turn your attention here to the momentum chart, because we've had these lovely moves where the price is going up, but the momentum has sort of flatlined and gets a mean reversion, which of course means the end of the rally. Now here we are. Momentum is not nearly as great as what we're seeing here in price. In fact, the 200 is above the 50, where here the 50 is above the 200. This is an accumulation phase as opposed to what we have here, which is a bullish phase. That's number one. And number two is that we are now sitting right at that Bollinger Band, which means that it could set up for another mean reversion. So watch that momentum carefully. Even if we went up a little bit more in price, if there's no real volume or things start to turn around on the momentum, we are seeing still a bearish divergence in momentum versus price. Okay, let's move on. I wanted to show you that this is on the heels of cocoa rallying to new highs and orange juice rallying to new highs. This is the soybean chart. This could be a game changer for the whole industry in terms of the agriculturals and the softs and people thinking inflation is over. Because at this point right now, people said food inflation declined and is down tremendously. But these numbers are so cooked, I certainly haven't seen it. Let's just say at the airport heading back yesterday, I bought 3 sandwiches and it cost $49 US. That's ridiculous for a sandwich. So anyway, looking at soybeans right here, caught my eye because it was up $7 today. So look what we see. We see the 50-day and the 200-day moving average. It was cleared a few days ago. This was on November the 3rd. And we came up and we're having a very orderly, typical type of rally that we see with these commodities when they technically get going. So at this point, what I'm finding so interesting about this is that we're not that far from the highs here. And yes, that's true about the equities, but we know that equities and commodities can go up at the same time until everybody looks around like a monetary mishap by the Fed and says, wait a minute, and commodities keep going. So in this case right now, I want you to keep your eyes on the soybean futures. This is the January contract. Right immediately, 1384, that's going to be your support. We come in and hold 1384. I mean, we can lower it a little bit to 1381. So let's say 1381 to 1384. Then I would think we could easily take out today's highs and go to the next real resistance that we have seen here, which would be up at around 1403. We get to 1403 and I don't see any reason why this can't keep going. Exactly what happened, like I said before, with orange juice and also with cocoa futures. If we take a look at a 2-year chart here, we also had a high here. This was back in 2022 at the peak of the commodities cycle so far at 1450. This would be obviously a place that you would be looking at if this thing really gets going. Where would I change my mind on this chart? Most likely at this point it would have to take out today's low. And if we take a look at today's low, it was 1368. That also corresponds very well with some of the work that we've had over the last few months. So that's your numbers here. With the WTI crude oil, again, we had talked about before I left how 93 was your major resistance. We got pretty darn close back in September, but we haven't gone anywhere near there since. And now you can see we've made a series of lower highs. That's why this obviously clearly failed the 50, which is now sloping down, but yet is also holding the 200. In terms of the viewpoint right now, looking at oil, you know, $80 was the big breakout that we talked about. And once we got down under 80, we said we would exit. And yet 76 is holding pretty well. So what we're looking at right now is for this to tell us what it can do at $80 a barrel. We can get back over $80 a barrel. I think we can get back up to 84 to 84.60. We cannot get through $80 a barrel. We're looking at this tomorrow, particularly with new numbers coming out. 78.50 is going to be your pivotal zone. Above 78.50 bullish, below 78.50 not so much. And of course, if we break back down under that 200, under 76.70, let's call it, then it would probably mean lower prices for oil. Finally, let's talk about natural gas. Well, we did, look how technical this is. This is your 200-day moving average. It never got through 4. That was my number. This is the D's contract. Never even got through 380 since I've been gone. And so naturally, it had to go down and test some lower levels right here. So in this contract right now, we could have a reversal bottom. It certainly confirmed yesterday, I should say Friday, with a more momentum movement to the upside today. But this again is now just still in a major trading range. One of the reasons why it's been weak has been because of the fact that they're expecting a mild winter. I don't know how anybody can necessarily count on that, but doesn't matter. For right now, I would not touch natural gas at all until we actually really clear this 200-day moving average. You can see we haven't been above it since December, almost a year ago. That's a significant breakout. So keep your eyes on that 360 level here in the December contract, and if it does, then we have a brand new ball game. Otherwise, I think between gold, what I showed you, soybeans, and the S&P, by the way, and the oil potentially, you have enough to look at. Just put this on your radar for a move over 360. Okay, that's it for now. Hope you have a great day. Talk to you soon. Bye for now.